Hi, welcome to this video on whole life insurance non-forfeiture options, what we're going to cover today. My name is Chris. I'm your life health exam coach and really like you to check out what we have to offer at lifehealthexamcoach.com. We have a great program, a lot of educational content that's all designed with one goal, and that's to help make sure that you pass your life and health exam. So if you haven't looked already, and you want to see how we can guarantee you'll pass your life and health exam, go to lifehealthexamcoach.com and check out what we have to offer. So today, as I said, we want to cover whole life insurance non-forfeiture options. So let's jump into our topic. Now, in other videos, we talk about whole life insurance, and here's a chart or graphic that I have of straight whole life policy. There are two components in a straight whole life policy. There's the insurance component, and then there's the cash value component. And it's a great thing about whole life insurance is it's not just the insurance alone, the death benefit, but it also has cash value that accrues. It builds over time. So from the point when you purchase the policy until you reach age 100 or 110, depending on how that policy defines the maturity date, the point where the cash value equals the death benefit. So, for most people, they keep these policies their whole life. However, there are circumstances where people decide that they don't want to keep their insurance policy anymore. And we want to look at what happens if you decide to do what's called surrendering your policy, which is, another term for terminating, ending your policy. Why would somebody want to stop their life insurance policy? Most people have got a whole life policy, and you think, well, they'd want that their whole life, right? Well, people have circumstances that change. Maybe they don't want to pay a premium anymore. Maybe they really need the cash value for something else. Or maybe they want to invest in something else. So, those are some reasons why somebody might opt to surrender their whole life policy. What we want to focus on today is what's called non-forfeiture. Everybody's heard of the word forfeit, right? It means to lose. So non-forfeiture is simply the opposite of that. It means you can't lose. You can't lose that cash value if you surrender your policy. Your straight whole life policy has a certain amount of cash value in it based on how long you've been paying into the policy. It's going to have a time period, and you can see very clearly in a whole life policy when you get the policy, you know how long it takes and exactly how much cash value you'll have at every point along the way from the time when you get the policy until you reach the policy maturity date. So if you pick a time anywhere along that line where you want to surrender the policy, it's very clear, how much cash value you have, assuming, of course, you haven't taken out any loans from the policy. So that could affect things. But it's very clear that you have a certain amount of cash value that has accrued in the policy over time. And if you surrender this policy, the insurer must give this to you because you're the one who's paid into it, right? So non-forfeiture basically means you can't lose that cash value when you surrender your policy. Now, there are several different options, though, of how you can receive that cash value. And that's what we want to focus on, these non-forfeiture options. And the first one is cash surrender. And this is pretty easy to understand. You just simply receive whatever the cash value is of the policy in a single lump sum when you surrender the policy. So, for example, let's say you decide to surrender the policy at a point when the cash value equals $20,000. So the insurance company will cut you a check for the $20,000, and then you're done. The policy is done, right? There's no death benefit anymore because you've terminated it. You just received the cash value for the policy, and that's the end. So that's one way in which you can receive your. Second way in which you can receive your cash value is in extended term insurance. So remember, term insurance is cheaper than whole life. And your cash value is then converted into a certain number of years of term insurance. Why would somebody want to do this? Because maybe they wanted to end the policy simply because they couldn't afford the premiums, didn't want to pay the premiums anymore, but they really still wanted life insurance. So this is a great option to, in a sense, convert your whole life policy into extended term coverage. So in this example, say instead of receiving that $20,000, which is your cash value, it's simply used to buy term insurance for however many years that covers. And you're not buying a separate policy, it's all done by the same insurance company, who has the policy. And they will just turn that into term insurance for a set number of years. It's simply based on how much cash value is there. So $20,000 in cash value would buy a certain amount of term insurance. Let's look at a kind of example of that here in the next slide. Here you can see in the graph that we have now a level term policy, right? Because you've taken extended term insurance, and that cash value of the policy is going to pay for a certain amount of time or a term. So let's say that you surrendered that policy at age 40. And let's presume that that $20,000 in cash value maybe would cover that same face amount, that same death benefit until age 70. So you would have the full death benefit if the insurer were to pass away during any time between age 40 and 70. And then the other thing that's important, remember, is that, of course, there's no more premium that's being paid because the cash value has paid for this extended term insurance. So, in effect, the person ends up with the same death benefit, but it's not whole life anymore, right? They're covered in this example until age 70. Again, it just depends on how much cash value is there, what's the cost of that extended term insurance that would define exactly how far it goes. But this could accomplish a person's goal of wanting to stay covered, keep that same death benefit, and not have to pay any more premiums. So that's the second kind of uh, non-forfeiture option. Next, we're going to look at the third option. This one is called reduced paid up insurance. So that's a fancy way of saying you're going to pay off the whole life policy early by reducing the death benefit. So again, if somebody's goal were to stop paying premiums and they still wanted to have coverage, this is another option for them. Now in this example though, let's say for example you had a $100,000 death benefit policy, and we'll keep that same $20,000 as the cash value at some particular age. And maybe they can pay off the policy then by reducing the death benefit to, for example, $50,000. So they're taking a reduced death benefit, but they are getting that as a whole life benefit. So instead of having a term where it's going to end, the reduced paid up is paying off your whole life policy early, and then you have a reduced death benefit, right? So let's take a look at a graph example of that as well. So in this case, the cash value of the policy is going to pay off the whole life policy, but with a reduced death benefit. So again, in the example I said, instead of getting $100,000, maybe it's $50,000. But the other benefit, again, why would they do this? Because they don't have to pay any more premium. It's paid up and it's going to last them their whole life. So it doesn't matter, what age they're to pass away, they're going to be covered for sure. So that's your third option that you can take on your non-forfeiture options. So what do you need to remember for the exam? We always come back to that key point. Number one is the cash value of whole life policies must be paid to the policy owner if they surrender the policy. That in itself is the definition of non-forfeiture. And remember, you've got three options. You can take that in a lump sum, which is called a cash surrender. That's the most common. But the second one is extended term, so you can get the insurance covered, for some set amount of time. Or you can take reduced paid up insurance, where you retain the whole life benefit. It's there for your whole life, but you're taking a reduced face amount or death benefit. So those are your three non-forfeiture options. Hope this has been helpful and sticks with you as you go and take the exam. We look forward to seeing you in other videos. And remember, check us out at lifehealthexamcoach.com. Thank you.